because gold and silver took a dive, as I have been warning about for the last two silver reports. Open interest was way too high for my comfort, and the COTs were showing that bullion banks were record short. That could have been covered the last few days, at least to some degree, but I don't think it's over yet. I think we have a few more weeks of this. Again, this shouldn't really matter for stackers that much, because premiums will even out the costs. But for traders, you want to keep being careful here and not necessarily buy the dip just yet. I think we have maybe 2 or 3 more weeks of this. But in the bigger picture of things, we have an imminent yield curve un-inversion, and each recession since 2000, I think even before, I think 1990, since 1990, each recession has occurred after an un-inversion of the yield curve. We could un-invert in the next few weeks on the 10-year minus 2-year. And on the money supply, it looks like we are headed back to absolute deflation. We could already be there. I will show you the latest numbers on the money supply and the 13-week averages, which I follow every month.
Recently, gold and silver prices experienced a significant drop, which Rafi Farber had anticipated in his previous reports. The decline is attributed to the high number of short positions held by bullion banks, essentially betting that prices would fall. This substantial number of short positions raised concerns for Farber, leading him to advise caution. In today's episode, Rafi points to an imminent financial crisis. The yield curve, which compares interest rates on short-term and long-term bonds, is on the verge of un-inverting. Historically, every instance of this occurrence since 1990 has been followed by a recession. Moreover, we are approaching a deflationary phase as the money supply is decreasing. Farber predicts that the Federal Reserve will likely have to cut interest rates to 0 in response to the next banking crisis. The Bank of Japan's recent actions involve selling dollars to strengthen the yen, yet there is no evidence of clandestine swaps with the Federal Reserve. Farber notes that the prices of all commodities, not just gold and silver, are falling, indicating broader deflationary pressures. This trend underscores the increasing likelihood of another financial crisis. There has been a notable reduction in open interest in short positions by bullion banks, which Farber views as a positive development. However, he emphasizes that this process must continue before a sustained rise in gold and silver prices can be expected. Various financial indicators, such as the gold to commodities ratio and the secured overnight financing rate, suggest mounting financial pressures. Make sure you hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our recaps. Also, check our description for full credit details if you want to watch the whole interviews. Enjoy the episode.
Or imminent at a yield curve un-inversion. This is the 10-year treasury minus the 2-year treasury. I'm not quite sure how important this is right now because the 10-year minus 3-month treasury is still a little bit farther away from inverting, but we'll see what happens here. According to this chart, at least after the yield curve un-inverts, meaning after 10-year treasuries become higher yielding than 2-year treasuries, we have just a few months until the next crisis. This is exactly what happened here. On the eve of the 2008 financial crisis, we saw the yield curve un-invert and head higher, which really just meant that 10-year yields were heading higher than 2-year yields on a relative basis. It happened over here in 2000. It happened over here in 1990. It's probably going to happen again, probably not in the same exact way. You can even argue it happened over here. This is a 2019 very brief inversion over here, and then headed higher, and then we had the whole, crisis that we shall never mention here in bad words, but everybody knows what it was. I think China was involved. So we just took a little lurch higher in the yield curve spread. And once we cross 0 and head higher to a more positive territory, that would signal the next financial crisis. And what happens then, of course, is that everything goes down, including gold and silver. Then the Fed prints, and then gold and silver go crazy, and silver the craziest, and other commodities less so, but they also go up. And that is when gold and silver gain the most purchasing power during financial crises, even though in dollar terms, it certainly doesn't feel that way. That is the reality. We're headed back into absolute deflation. We could be there already. If we look at the weekly money supply numbers that come out every month from the Fed, from the Fed charts, if we calculate the 13-week average annualized quarterly money supply growth rate, we are back to below 1% annual. You can see here that we are about to cross below the 0% line. This is the absolute deflation line, meaning on a quarterly annualized basis, money supply is heading down, and we are heading down again. We briefly broke the deflation plane over here in late 2023. I think it was December 2023. And we've been very low above it since, but we're headed back down into absolute deflation, which means we are headed back into another piece of evidence. The next financial crisis should come pretty soon. And if you look at the absolute money supply here, going back to 2008, this is the 2008 financial crisis. This tiny little move up in the money supply here is the printing round in 2008. It wasn't much of anything compared to what happened in 2020, of course. And we see a fairly fluid increase with the seasonal bumps in money supply going up until 2020, and then wham, the COVID printing. And then we have the peak in money supply, and this is pretty much exactly when they started hiking interest rates, when the Fed started hiking the effective federal funds rate. And we went vertical on the EFFR, on the overnight interest rates, and then right then, money supply stopped growing. Look at that. Who'd have thunk? And it's been pretty flat ever since. There's a tiny little growth here, which you can see in the previous chart, where we went below the, we went above the deflation rate. We went above zero, but now we're going back down again, and we should keep going down into August, September, and go back into absolute deflation. And because these numbers are on a month delay, we could already be there now. This is the Fed's Forex reserves, meaning if there's any evidence of them doing swaps with any central bank, those swaps would show up here. A swap is when the Fed agrees to print dollars in exchange for currency directly from a different central bank. Why Japan would do this is because they need dollars to sell to strengthen the yen, which might be what you could theorize that's what they were doing to bring the yen back up to, I think it's around 153 now to the dollar, but there's no evidence that this is happening because there's not much movement in the Forex reserves at the Fed. This would include yen if it's going on its balance sheet, but it doesn't seem that that is the case. So therefore, what is happening is the BOJ, the Bank of Japan, is selling its own dollar cash and running out of ammunition. They will run out at some point soon. Estimates on this kind of move is something between $40 and $60 billion spent. I don't know how much they have left, but it's a lot less than before. I'm going to go into here the COT evidence for gold declining these past few weeks, which I warned about in the previous two silver reports. I was uncomfortable about the commitment of traders reports here, especially the number of shorts held by the bullion banks. It was at a record high, meaning a record negative number here. This is the negative number, means a net short position. It was about 250,000 contracts short, which has never been held before. And you can see in these these rectangles of love, as I call them. I don't know why I call them that. I don't know. I can't think of a good name for them. So rectangles of love is.
In today's market news, silver price forecast, silver continues to look miserable. The silver market has been beaten quite drastically overnight again as the sell first, ask questions later panic continues. This isn't just silver that is suffering at the hands of this panic. It's everything. Silver being naturally volatile is yet another reason to be worried about jumping into this market anytime soon with a huge position. Silver had another brutal overnight session, plunging down to the $27.50 level before finding any support whatsoever. Ultimately, this is a market that I think needs a lot of help. And the hotter than anticipated GDP numbers coming out of the United States could potentially give it a little bit of a boost from an industrial usage standpoint. But quite frankly, it seems like everybody's more worried about panicking now than they are anything else. Remember, when assets get sold off in mass like they are right now, silver gets absolutely killed, as it is a volatile market and a huge contract, and people will sell first and ask questions later, as computers also add to the noise. A lot of traders have made quite a bit of money in the silver market, so it's not a huge surprise to see that the bottom has fallen out. The question now is whether or not we can bounce, and I think you're going to have to look over at the gold market for signs of that happening. There are signs that we're at least trying to slow down the bleeding, so given enough time, I think we may turn around. But right now, I would not be touching the silver market. It looks extraordinarily toxic, and it wouldn't surprise me at all to see silver race towards the 200-day EMA before it's all said and done. Make sure you hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our recaps. Also, check our description for full credit details if you want to watch the whole interviews. Enjoy the episode.
You see here that we had a record short position in 2022, it looks like. Yeah, this was March 7th, 2022, during the nickel Armageddon fiasco. That was a long-term, medium-term top in gold here. We had the same record short position over here. At that time, a record short position in 2020, just prior to the unnameable crisis that we shall not talk about. And this little bump over here, this little inversion, this little V, that was the March 2020 COVID crash that freaked everybody out and brought gold down to 1450 and silver down to like 1150 or 1110 or something like that. And it hit a lot of people out of the game who were leveraged, and you don't want to go through that. But, you know, on this long-term chart, it doesn't look like anything, but it was pretty big at the time. Back here, the previous record in bullion bank short positions at that point was during the 2016 high after the initial move out of the 4-year gold bear market. Again, it was a record short position in bullion banks. And we had the same over here in 2015, another little local high over here. So judging from history and looking at the record short positions in bullion banks, it wasn't very safe over here, and we've got to lower these numbers before we can go on another trip higher. And they will come down. It's going to take a few more weeks, but they will even out. And the open interest, which is related, we can see here that yesterday, Thursday, July 25th, 28,638 contracts were closed, bringing open interest down, and that means short positions, net short positions by the bullion banks, down about 30,000 contracts. These numbers over here on a week delay or a 2-week delay, something like that. So we'll see where they come up to, and I expect the bullion banks to close their shorts as the managed money closes their longs as they're chased out in this price correction. This is the number down here of August gold contracts, the active contract that's going to be rolled over into December, I think, or that is being rolled over. 45,000 closed out for a net closing of close to 30,000 contracts. So looking good. This has to keep going, and we'll see where it ends up, but stay cautious here. Well, I forgot to title this one, but anyway, this is the gold to commodities ratio. I've shown this before. I just wanted to give you an even longer view of what is going on. And we see here that gold keeps climbing relative to other commodities. So its real purchasing power and versus raw commodities is now at 3.325, which is much higher than the 1980 high. And people have asked me, well, what does this matter? It doesn't really affect consumer prices that much, but indeed it does, except it's on a longer lag, because we're talking about raw commodities, which takes a long time for that to filter into the consumer goods sector. And I made a point in my latest Substack that, in my opinion, even if gold is manipulated, which I believe it is to some extent, I don't think that those that are manipulating it are doing a very good job, because if they were very good at manipulating gold and silver, or did it very effectively, then this chart would be going down and not up. Everyone can have their opinions. I could be having tunnel vision on this issue. I'm not married to it. This is just what I think, and you're free to disagree. The point being that if they're manipulating gold down more than other commodities, this would be going down and not up, but it's not. It's going up and not down. Another thing I wanted to show you about this chart is that the two biggest moves we've seen in gold versus other commodities were during the 2008 financial crisis right here, where it went from 1.5 to 3 a doubling in a few months, which was pretty similar to what it did in the late 1970s to 1980. That was about a tripling, even more than a tripling. So it wasn't as big as the 1980 move, but it was pretty significant. The other major move was during this financial crisis in 2020, where we hit a high of about 5.25 or whatever that is. And this bear market from the peak of the lockdown crisis until about 2022 was a much worse bear market than the 2011 to 2015 bear market, which was around here, which was bad, but nowhere near as bad as this one. But in dollar terms, it was worse. So just keep in mind this chart for a bigger perspective, I'd say, or a more balanced perspective as to what is happening in gold versus the commodity space, which is, I think, much more important than gold in dollar terms. The last chart that I wanted to show you is that we keep moving higher and higher and higher, including this week where we made a new record high in secured overnight financing rate. This is the repo volume, how much dollars are being transacted every night between banks. It goes up and up and up because funding necessities for big banks keep going higher and higher and higher. And remember, these dollars are not being taken from nowhere. They're being taken from bank reserves. And the more bank reserves they take, the less bank reserves are available for other things. And once they run out, this rate is going to spike up just like it did in 2019 over here. And we're going to trigger another banking crisis. It's going to come from here. I don't know if it's going to start here or this is going to be somewhere in the middle of the crisis, but it is coming. And this volume is not going to go down because as the monetary base shrinks and the Fed continues its quantitative tightening, banks will need more and more of these dollars to fund their overnight needs.
What do you think of Rafi's take? Are you interested at all in the end trade, or would you rather just enjoy this dip to accumulate more gold and silver? Share in the comments section how you're navigating this environment, and feel free to share your journey with the community. What's your price target for gold and silver in 2024? Is Rafi totally wrong in his banking prediction? Will Trump be the next president of the United States? Let's discuss because we want to know. Now watch this video right here because it's a perfect fit for you. I see you on the other side.